Welcome back. We are now in segment 5.7, and in this segment we'll be discussing about the calculation of depreciation. So please recall, in the earlier segment 5.6 we have discussed the concept of depreciation. We spoke of depreciation being a method of allocating, right? A method of allocating or spreading, right? Spreading the cost or allocating the cost of an asset over the life of a asset. So you'll take the life of the asset, say 5 years or 10 years, and then you spread the cost. For example, 10 crores, you'll spread this cost over a period of 5 years. So that is what we discussed the concept. So now how much to allocate in each year? So if the machinery is valid, has a life of 5 years, so the 10 is the cost of the machine. So should we show 2 crores in each year? We get the total of 10, or 1, 2, 3, right? How much do we have the total? 6, right? 2, 2, 10. This is also 10. So, or some other combination. So how much to show? So what is the methodology we have to follow in splitting the cost of the asset over the period of the life of the machinery? So this is what we are going to discuss in this chapter. So there are various methods of calculating depreciation, right? We have the SLM method. That is the straight line method. We have the WDV method, written down value method, and we have various other methods like like sum of digits method, and various other methods which we are not worried about, because SLM method and the WDV method are the two most popularly used methods. In your banking career, most of the balance sheets which you encounter will be calculating depreciation based on the WDV method. For small firms, you can have the SLM method also. So these are the two methods which you're going to encounter frequently. So we're going to discuss these two items. So the SLM method, the straight line method, we have discussed actually this earlier. So in an earlier example, in the earlier segment, we spoke of an example where the cost of the asset was 20 crores. The cost of the machinery was 20 crores, whereas the life of the machine was 10 years. So then we said, why not split the cost of the 20 crores over a period of 10 years and allocate every year 2 crores. Right? This is what we discussed in an earlier example. So that is straight line method. In the straight line method, we calculate depreciation simply by dividing the cost of the machine, say 20 crores, by the life of the machine, say 10 years. And then we arrive at a depreciation amount. So instead of showing the 20 crores in the first year itself, we show these 2 crores for the period of 10 years. Right? This is the straight line method. Straight line method is a very simple formula. This is a very simple formula. In practice, straight line method is indicated by some percentage. So they say 10%. Say for example, depreciation is 10%. So what it means is, if the cost of the machine is 20 crores, so the depreciation is 10%, means 10% of 20. So that is 2 crores. Right? This is exactly what we arrived earlier, right? When we said the cost of the machine is 20 crores, is going to be spread across 10 years, we arrived at 2 crores. This is also same, 10% of 20. So usually in practice we speak in terms of depreciation in terms of percentage. So when we say the rate of depreciation is 10%, it means 10% into cost of the machine. So whatever is the value arrived, that will be the depreciation amount. So every year you're going to show this depreciation amount in the P&L account. So straight line method depreciation is very simple. It's just the formula, right? The formula is initial cost of the machinery divided by life of the machine. You're assuming some life of the asset. You're assuming whether it's 5 years or 10 years, and you're making a reasonable assumption. Usually this is provided by the supplier. So the machinery supplier will be having a good idea as what could be the useful life of this machine. So based on that, you'll be arriving at the useful life of the assets, and then you'll arrive at the formula, calculate depreciation, right? The other method is the written down value method, WDV. So in this method, right, we have to speak of the concept of accumulated depreciation. So let us see what is this method, written down value method. Let us have a new term called gross block. So this is the original cost of the machine. So if you assume the cost of the machine is 20 crores, so in every year it will be 20 crores. This is the original cost of the machine. This is the original cost of the machine. So every year it is 10 crores. Then we have depreciation for that particular year. So under straight line method, we told that every year 20 is the original cost, 10 years is the useful life. So every year you have to apply the same depreciation. Now I'll show something called accumulated depreciation. Accumulated depreciation is how the depreciation is building up. In the first year it is 2. because this is the first year. We have no past figures. This is 2. In the next year, we have actually applied depreciation twice. The first year and the second year. So 2 plus 2 is 4. Right? In the third year, it will be 6. Because we have applied depreciation in 3 years. Finally, this will be 20. The accumulated depreciation will finally be 20. Now, if you calculate what is known as the net block, net block is gross block minus accumulated depreciation. Right? Gross block minus accumulated depreciation. So here it will be 20 minus 2, 18. 20 minus 4, 16. 20 minus 6, 14. So on. Finally 0. Is the point clear? Under straight line method, the depreciation will be constant for all years. And that is calculated by the formula cost of the machine by useful life of the machine. In percentage terms also you can speak. Like 10%. So 10% of 20 crores, 2. So either in percentage terms or using this formula. So that amount which we arrive at, every year you are going to depreciate it through uniformly. For all years you are going to apply depreciation of 2 years. Now I have introduced a new term called accumulated depreciation, which means what is the depreciation in total you have applied till now. So in the first year it is 2 crores, but in the second year it is 4 crores because you have applied depreciation twice. In the year 1 and year 2. This is a total depreciation applied. So this will be getting accumulated. By the end of 10th year it will be 20. Now we are going to define net block as GB, gross block minus accumulated depreciation. This will be 18, 16, 14, still 0. So what actually this means? So what actually this represents? This represents the true value of the asset. Right? We spoke of earlier that balance sheet should reflect the true position of the company. So in assets you have land, building, machinery, a lot of assets. So the machinery, whatever the balance sheet is showing, it should be a true position. So it should never show 20. 20 is only the value this machine is going to fetch in the first year. But in the second year, a balance sheet should show the true position, that is 18. Because now the machine value has gone down. It is worth only 18. So you have to show 18 here. Right? So in the balance sheet, the figure you are going to show is always the net block, not the gross block. You can show the calculation balance sheet if you want. Gross block minus accumulated depreciation is equal to net block. But while arriving at the total of the asset side, you are going to take only the net block. So net block you are going to arrive by deducting accumulated depreciation from the gross block. Right? Is this point clear? So what net block is showing? Under the asset side, it is showing the true value of the asset. Right? Taking into account depreciation. So this is straight line method where every year the depreciation is same. Now let us look at written down value method. So let us calculate depreciation as per the WDV method. So here we are taking example of the same example where the cost of the machine is 20 crores. So gross block is 20 crores in all the 10 years. Now depreciation will calculate as per the WDV method. In the first year anyway it is 2 crores, right? 10% of 20, that is 2. Accumulated depreciation also 2 because there is no past year. So this is 2. And the net block is nothing but gross block minus accumulated depreciation. So this is 20 minus 2, this is 18. So in the next year, right? In the next year, we'll calculate depreciation 10% of depreciation in WDV method is 10% of the written down value, that is the net block, not the original cost. In SLM method, we calculate 10% of the cost of the machine, that is 10% of 20, 2 crores in all years. In every year it is going to be same on the SLM, but in WDV it's going to be different. 10% of this 18, 10% of net block, so 1.8. So now what is the accumulated depreciation? 2 plus 1.8. Accumulated depreciation is total depreciation up to this year. So 2 plus 1.8, 3.8. And what is net block? Gross block minus accumulated depreciation. So this is 16.2. In the third year, depreciation is 10% of net block. So 10% of the previous is net block, 1.6. Accumulated depreciation is depreciation up to this point of time. So 2 plus 1.8, 3.8 plus 1.6, 5.4. And net block is gross block minus accumulated depreciation, 20 minus 5.4, 14.6. And this calculation continues. So if you do the calculation, this is how the table will look like. Right? The depreciation will be decreasing. Every year it will be decreasing by some amount because the net block is decreasing. So initially it will be 2 first year, then 1.8, 1.6, 1.5, so on, and finally at the end of 10th year it will be 0.8, right? Accumulated depreciation is just the how the depreciation is built up. So in the first year it is 2, second year it will be 2 plus 1.8, third year it will be 2 plus 1.8 plus 1.6, that is 5.4. Fourth year it will be 2 plus 1.8, 1.6, 1.5, that is 6.9, so on. Right? Net block is simply difference of gross block and accumulated depreciation. So this is how the net block is arrived. So this is the calculation for depreciation. So earlier in a straight line method, every year you got depreciation as 2 crores, but here under WDV depreciation is decreasing. Initially it is 2 crores, which is same as SLM, but then it goes on decreasing. Right? So there are a couple of points you need to keep in mind here. One, by showing this WDV, that this decreasing depreciation over a period of time, we are actually satisfying the matching principle compared to SLM, right? See, in SLM what we did was every year we're showing 2 crores, 2 crores, 2 crores, right? But when we spoke of depreciation, there are three ways of looking at depreciation. One of the ways we said was depreciation is a resource that is being consumed, right? Machine is the asset, is a resource that is consumed. So machinery, you have to show the cost of the machine, just like you're showing the cost of raw material or labor. You have to also show the cost of the fixed asset, and depreciation is a way of showing the cost of the fixed asset. But we also told that in the initial years the machine will be performing better compared to the later years. So when you buy a fridge, initially the performance will be very good. First year, second year, third year, and as the years go by, the performance drops, right? So even in the case of the machinery used by the companies, initial years it will be very good, the performance will be very good, and in the later years it will go on contributing less and less to the sales. So initially it will generating a lot of sales in the initial years 1, 2, 3, like that. It will be generating a lot of sales because the performance of the machine is very good. As the years go by, in years 6, 7, 9, 10, like that, we're assuming the age of the machine, the useful life of the machine is 10 years. So by the end of 10 years it becomes useless, in the sense that the revenue generation will come down. It will not contribute that much to the production process. So when you speak of matching principle, what does matching principle says? You have to match the revenues and costs. So since the revenue is decreasing over a period of time, the cost of the machine or the expense which you're showing under head of depreciation should also decrease. So initially we are showing a higher amount of depreciation under WDV because the machine is contributing to a higher amount of sales. In the later years, we are showing a lower amount of depreciation because the machine is contributing in a lesser way to the manufacturing and the lesser way to the sales generation. So this is as per the matching concept. So initially years we are showing a higher allocation, later years we are showing a lower amount. This is as per the matching principle, right? You have to also always match revenues and expenses. In the initial years, since the machine is contributing in a higher way to the sales, let us show a higher cost of the fixed asset, that is higher depreciation. In the later years, since the machine is not performing that well and it is not contributing in a big way to the sales, show a lower cost of the fixed asset, that is the lower depreciation. So WDV method is a more correct way if you are talking from the matching principle point of view. From the matching principle point of view, WDV is a better method compared to the SLM method. So that is one point which you have to remember. The other point that I want to tell you is, ultimately at the 10 years, what we said, at the end of 10 years the machine is going to be useless because we are assuming that the life of the machine is 10 years, which means the balance sheet what we are showing under the assets we are showing a machinery. So this machine should always show the true picture of the company. So in the year 1, if you are going to sell the machine, you should realize 18 crores. That's what you're saying. And that's why the value is decreasing. You're going to show the net block under the assets column. So initially, even though you purchase the machine for 20 crores, after 1 year, since you spend this, you use this machine for 1 year, it's going to fetch only 18 crores. That's why you're showing 18 crores in the year 1 balance sheet. That is correct. You're not going to show 20 crores, you're going to show 18 crores. Correct. In the second year balance sheet, year 2, the balance sheet, you're going to show only 16.2 crores. That is also correct because now you have used the machine for 2 years. Its value has further come down. So showing 16.2 is correct. Right. So every year you're going to show a lower amount. Right. But what about the 10th year? See, in the 10th year, you're saying the machine is becoming useless. The life of the machine is 10 years. So after 10 years, this machine is of no use, which means this value should be 0. Isn't it? So after 10 years, when you're saying the life of the machine is 10 years, as per the balance sheet, since balance sheet has to show the true picture of the company, this should become 0. So what actually in practice they do is, this is a small point, the depreciation in the final year, what they show, instead of 0.8, whatever is the leftover amount, right? Whatever is the leftover amount, directly they'll be showing the depreciation. That is 7.7. So this 7.7 is the net block as on year 9. So this 7.7 directly will be showing as the depreciation for the year 10. So thereby, now you'll be getting a accumulated depreciation of 20. 12.3 plus 7.7, 20. And net block will be 20 minus 20, 0. So finally you'll show the position 0, which is correct, because after 10 years the machine is of no use. So the balance sheet now shows a correct picture. Actually, you will not find such a big difference like this. All these years it was around 2 and 1, in between 1 and 2, right? Depreciation. Suddenly it is 7.7. It won't be like that. This is an example which we consider. In real life, it won't be like that. Some amount will be left over, and that amount will be pushed to the last year, the year, right? This won't be so much variation. This is only an example. But the point is ultimately it has to become 0. If you shown only 0.8, it's not becoming 0. So what they do in the final year, they will push that entire WDV amount into the depreciation. So finally the machine will become 0, right? The WDV will become 0. Another point that you need to remember is sometimes companies depreciate assets slowly in order to boost income. So in the P&L, please note that depreciation is a expense. So you have all income items like sales and all other income. Under the expenses, you have various expenses like raw material, power, labor and all. And depreciation is also an expense, though it is a non-cash expense, but still in P&L we are going to show it as an expense. So thereby you are going to arrive at some profit. Higher is the depreciation, lower is the profit. Right? So always, not always, sometimes, if the company wants to show a lower profit, thereby have a lower tax, it will going to show a higher depreciation. So if depreciation is higher, which means the total expenses side will be higher and your profit will be lower. So consequently, you'll be paying a lesser tax. So if the company wants to evade tax, this is one way which companies will try to fool you, right? So because there's a choice between SLM and WDV. So sometimes companies can change the method of depreciation, and change in the method of depreciation from SLM to WDV or vice is commented under the significant accounting policies. We already discussed significant accounting policies. So the auditor usually will be commenting on this change. If the method of depreciation is changed from the previous, usually it won't change. If a company chooses to employ WDV for this asset, it will be continuing with WDV throughout the life of the asset. But in between, if it changes, the auditor will be commenting under the significant accounting policies. So please read significant accounting policies, because they are part and parcel of the balance sheet. Balance sheet doesn't mean just the figures of P&L and balance sheet, not just the numbers, also the qualitative statements which the auditor makes, right? They're also important. So please look at the significant accounting policies and see if the method of depreciation has been changed. Don't doubt the company just because it's changed. If there is a reason, fine. You have to ascertain the reason. If it is a justified reason, fine. There's nothing wrong with it. But sometimes companies do this to affect the profitability, right? So we spoke companies will show a higher depreciation to have a lower profit and have a lower tax. So higher depreciation means lower profit, because expenses are more, so profit will be low, tax will be more. Sometimes companies, if they want to show higher profit, here tax evasion is the criteria. Sometimes companies want to show a higher profit. For example, this is a listed company which is listed on stock exchanges, and the profitability is keenly watched by the analysts. They are tracking the profit of the company. So to show higher profit, now more than the tax, the performance, the share price is important. So they want to show higher profit. Then they may show a lower depreciation. So lower depreciation means lower expenses, which means higher profit and thereby higher share price. So depending on the requirement, companies can fudge around these depreciation figures. So there are two ways in which companies can affect the depreciation figures. One, the method of depreciation. By changing, we discussed only two methods, SLM and WDV, but there are other methods also. So if the company changes the method of depreciation, that will affect the profitability, and thereby it will affect the depreciation amount and thereby the profitability of the company. So this is something you have to keep in mind. The other thing which companies can do is the depreciation rate. The rate of depreciation is something which companies can play around, and thereby arrive at a different depreciation amount. Say for example, in the earlier examples, we calculated a depreciation based on 10%. So why 10%? So who said 10%? So depreciation rates are actually stipulated by the Companies Act, right? So the Companies Act will be listing the depreciation rates to be followed for various assets. So I'll show you the table now. I'll show you the table right now. So this is the depreciation rates as per the Companies Act, right? So Companies Act will be stipulating various rates of depreciation for different assets, right? So based on the WDV or SLM method. So here you can see buildings, factory buildings, plant and machinery, right? We have say various assets. You have the cycles, electrical machinery, motor cars, right? So earth moving machinery, molds, right? Motor buses, on hire. You have the data processing machines like computers, furniture, and fittings, right? So various assets. The Companies Act will be stipulating rates of depreciation to be followed for the various assets. So even though this is sacrosanct, even though this is to be followed, sometimes company will have the flexibility to follow different depreciation rate as long as it can justify. So in the significant accounting policies, they will be saying, so even though the Companies Act requirement has stipulated so and so, we are following a depreciation of, say, a higher depreciation amount. For example, depreciation is 20% on a particular asset. So what the company will say is, we feel that, so SLM method, if we have a 20%, which means the asset, you are assuming that the life of the machine is 5 years. So SLM method, what the asset SLM method means, initially the cost of the machine is 100 lakhs. Then because it's 20%, first year you apply 20, then it becomes 80. In the next year again apply 20, it will be 60, 40, 20, 0. So in 5 years it will become 0. So if the Companies Act has stipulated a depreciation rate of 20% on SLM, it means in a way it is assuming that the life of the asset is 5 years. But the company will say the machine which we have, or the asset which we have, it has a useful life of only 3 years. We feel the useful life is only 3 years, or they'll say the useful life is only 8 years. This is, and they will provide supporting documents. They will provide the justification, the assumptions based on which they are making this claim, whether it is a lesser amount or the higher amount, and then they will calculate depreciation accordingly. So they can either increase the depreciation amount or decrease the depreciation amount with a view to increase the profit, with a view to decrease the profit or increase the profit. This we have discussed earlier. So if the company has if a company does like this, right, it follows a different depreciation method, then it will be listing it out in the significant accounting policies. The auditor will be pointing out. So there are two ways in which you have to understand. There are two ways in which a company can play around with the depreciation figure, right? One is the method of depreciation, and other is the depreciation rate. So if the company wants to really affect the profit, right, either with a view to evade tax or show a higher profit, whatever may be the intention of the company, it can play around with these two, either with the method or depreciation rate, and affect the profit. So this is something we have to keep in mind. So peruse the balance sheet carefully, read the significant accounting policies very carefully, and the depreciation. So in case the company does anything strange, you can spot it, right? So we'll continue with the example of Maruti Suzuki. In Maruti Suzuki P&L account, we have the item called depreciation and amortization expense. We'll discuss amortization later. Right now, let us see the depreciation. So this schedule 30 here gives the breakup between depreciation and amortization. So depreciation is actually on tangible assets, whereas amortization is on intangible assets. We'll discuss it when we come to the intangible assets. So right now, the depreciation amount is 11011. So let us take this figure and place it in the CMA data. So this is 1101.1 crores. This is in millions. So in crores, this is 1101.1 crores. So let us have this figure in the CMA data. So we have entered the depreciation amount 1101.1 under the depreciation row of the CMA data. So the expenses we have considered so far in the CMA is raw material, stores and space, power and fuel, labor, other manufacturing expenses, and depreciation. Sometimes if you want to have an additional row, you can add it. Sometimes company add a additional row called other expenses, if they really want to highlight some particular item. Other manufacturing expenses actually takes care of all the remaining expenses, but if you want to have a specially highlight a particular expense which is peculiar to this company, it wants to highlight this particular expense, because bankers might be asking what is the breakup of this other manufacturing expense. This is so high. Why is this so high? So maybe to highlight a particular expense, company might be showing. For example, this company might be engaged in outsourcing some of its jobs. So processing charges, they might highlight it separately. So if they want, they'll be having an additional row after depreciation if they want, right? If it really wants to highlight a particular item, that can be done. Usually they'll be clubbed under other manufacturing expenses, right? So with this we come to the end of the concept, end of the chapter, end of the segment. In this segment, in the previous segment, we have discussed the concept of depreciation and have discussed the methods of calculating depreciation. So in the next segment 5.8, we'll continue the discussion of the CMA data, and now in the next segment we'll start with the discussion on opening stock of work in progress, closing stock of work in progress, and opening stock of finished goods and closing stock of finished goods. So this is very important from the matching principle. Our good old friend matching principle will once again visiting us in the next segment. So see you then.